Grow Your Wealth newsletter for the 25th of the 11th, 2008. Last week we saw our market go to a low of 3,226. We started the week at 3,700 and finished the week at 3,400. What we can take away from this is two things. One, we may have seen the bottom. Now this is not certain, but we certainly did see a lot of support and a lot of strength around the 3,226 level. In fact, once it hit this on Friday, the market did rally back to 3,400, closing up for the day of 2%. Now this is an intraday swing of 5% and certainly a positive sign. Now, our market has fallen over 50% over the past 12 months, which eclipses the 87 crash and is even further than the Great Depression. We still haven't passed the OPEC oil shock of the early 70s, where our market fell further, but if we continue to fall, we probably certainly will. The big concern here is household wealth. Now, by the end of this year, we expect household wealth to be 10% lower, which is a massive turnaround from last year where it posted a 15% gain. Now, this is a concern mainly in the back of consumption. Lower household wealth generally means lower consumption. Combine this with rising unemployment, and you may see a further slowdown in our economy, and I no doubt this is on the way. Now, we have got the government working hard with interest rates being cut, and we're even seeing petrol prices coming off, but this may not be enough to get our market back where we need to be. What should we do? At this point in time, I'm comfortable to hang on. I think we will see a bull market rally, and we'll see the market back around between 4,500 and 5,000 in the coming months. At that point, there will be a need to have a look at our portfolios, reassess our positions, and possibly, and most likely, look at paying down some debt. Now, the other thing I want to touch on today was advice and where do you get it. Last week there was two good examples of people who didn't want to pay for advisors' recommendation of advisors' advice, and as such have got themselves in all sorts of trouble. The first one is with Brisbane Connection. This is a float that we were not involved in, thank God, nor that we would have been involved in. It was not a good float from the outset. Now this came in two parts. In this float you had to pay $1 up front and a second payment of $2 18 months later. Now it was a dud float. It went from $1 to 1 cent in about 3 or 4 months. Now some unsuspecting discount broker client jumped in there looking for a spike from 1 cent and bought himself 5 million shares at 1 cent. Unfortunately, he cannot offload those, and those who are in the know were happy, more than happy to sell in those shares to get out of the obligation of having to pay the $2 later down the track. Now this poor punter has saved himself $50 in brokerage, but is now on the hook for $10 million in the coming 12 months. Now, don't get me wrong, yes, the underwriters will come looking for this money, and no, he will never get it back, nor can he sell these shares on market, because of course, brokers are well aware of what the situation. Now here's a punter who saved himself some money, but obviously he's going to lose everything he's got over time. The other one is gearing in retirement. There's been a lot in the newspapers about this recently. In a bull market, gearing is great. It doubles your gains, but in a bear market, it also doubles your losses. Worse still, if you do not have any incomes, the bank may call in your loan. Now, in retirement, your income comes from your investments. So let's review and see what's happened here. You've lost most of your investments due to the market fall, at least half of it. You've also lost half of your income because of the market fall. Now the bank wants you to pay back the loan because you can't cover it with the income from your investments. What happens is the bank will take your house. Now the cost of a plan, for us to do a plan about this sort of issue for our clients, would be around $2,000. Now for those who didn't get our advice, or anyone else's advice for that matter of fact, the cost is now their house. Look, it does cost money to talk to brokers, and sometimes you feel like you're not getting ahead, or you feel like they don't have all the answers. But certainly the money that will save you over time more outweighs the money that it will cost you to talk to us. Good advice is like good coaching. Without it, you'll never be a top performer. The gains will always outweigh the costs. For more information, go to our website at growyourwealth.com.au.